Welcome to the deep dive. We're here to, cut through the noise and really zero in on the stories shaping our financial future. And today, wow, we're plunging into something that really sits at this fascinating intersection. Traditional finance meet the cutting edge of decentralized digital money. It's a story about huge capital, big market shifts, and really what it all means for the future of money itself. This isn't just another crypto headline, folks. It feels like a really vital chapter in how global finance is evolving, and it's happening right now. So our mission today, we want to thoroughly unpack a really significant development. We're talking about the recent surge of Ethena, specifically its ENA token. And this surge came right after a, staggering $530 million investment was secured by a treasury firm called Stablecoin-X. Now that number, $530 million, it's not just big, it's like a massive flashing sign. It highlights some critical shifts happening in the stablecoin world, and it shows this growing, robust confidence from institutions in decentralized finance, or DeFi, seeing DeFi as a legitimate, powerful force in the global economy.
And to help us navigate all this, we've pulled together a pretty wide range of sources. We're looking at crypto news reports, from places like The Block, and market analysis from firms like Masari, Chainalysis, getting that crucial data. We even dug into governance documents from key DeFi players, MakerDAO, for instance, to see their thinking. And we rounded it out with some, foundational papers from institutions like the IMF, the BIS, to get that broader macro view. So this mix, it should give us a really comprehensive picture, right? From the immediate price charts all the way to the big systemic implications. Our goal by the end of this deep dive is for you, our listener, to walk away with a really clear picture of what this $500 million investment actually means. We'll explore how it shakes up the competitive stablecoin scene, what it suggests for digital assets moving forward, and really what these big shifts signify for anyone interested in this whole evolving Web3 financial ecosystem. Think of this as your shortcut to getting seriously informed on a development that feels, pretty crucial right now. Okay, before we really dive deep, just a quick note.
If you find these insights valuable, if this helps you understand things better, please take a second to engage with us. Liking the content, dropping a comment, maybe a question or your own take, and subscribing to the channel. It honestly really helps support what we do. Your engagement is vital. It boosts us in the algorithm so more people can find these deep dives. And at the end of the day, it lets us keep bringing you this kind of in-depth analysis on crypto and Web3. So, your support makes a huge difference. Okay, so with that broader context set, let's zoom in on the immediate effect this news had. What's really compelling, I think, beyond just the price pop, is how this money isn't just about Ethena, right? It says something bigger about Web3's direction.
Indeed. And what's fascinating here is, like you said, it's not just one token or one investment in isolation. It's this really powerful, very visible story about serious institutional capital flowing right into DeFi. And this isn't just a pat on the back for a sector that, let's be honest, wasn't long ago seen as purely experimental, maybe even niche. It fundamentally changes how the market sees things, and it massively expands what these projects can actually do. An investment of this size, it speaks volumes, signals a new level of maturity maybe, and trust.
Absolutely. And you saw that impact almost instantly, didn't you?
Yeah.
Let's start right there with the headline news. Ethena, ticker ENA, saw a pretty dramatic price spike. The core info is ENA surged, about 12% shortly after the announcement hit. And it wasn't a slow creep up. It was fast, clear, an unmistakable market reaction to this specific news.
Yeah, that 12% jump, that's definitely not just random noise in a market that, let's face it, can be pretty volatile. It's a direct, measurable reaction to what the market perceived as major validation. In crypto, sentiment and news move prices incredibly fast. So a sharp move like that, it's a clear signal. Market participants basically immediately price this in as a really positive thing. It just shows how quickly these digital markets absorb and react, especially when big institutional money is involved. It signals a shift in confidence from the smart money. If you looked at an ENA price chart from that time, you wouldn't see gentle waves. You'd see a distinct, almost vertical line upwards. Really highlights that immediate, strong reaction. It's not just technical, it's psychological too, people rushing to get exposure.
Right. And the why behind that spike, that brings us straight to Stablecoin-X securing that massive investment. Can you unpack that a bit more? What makes this $530 million figure so, staggering? And what does being a treasury firm actually mean here?
Sure. So Stablecoin-X, they operate as a treasury firm, and they pulled in $530 million. That figure isn't just large, it's frankly monumental, even in the context of DeFi, which is growing fast. Just for perspective, $500 million. That's typically not coming from individual retail folks clicking buy. It's screams substantial institutional backing. It's strategic capital from major players. And when we say treasury firm, what does that imply? It means their job is very specific, very critical. They manage and safeguard large pools of assets. And crucially, these assets are mostly traditional financial instruments, think highly liquid government bonds like U.S. treasuries, or similar low-risk stuff. Why? The whole point is to provide a solid, tangible backing for digital assets, especially stablecoins. Their job is to ensure the stability, the solvency, the liquidity of these digital currencies. They're like a bridge connecting TradFi reliability with Web3 innovation. It's not a speculative trading operation. It's about building secure infrastructure.
Okay, so given that scale, $500 million, how might the motivations of these kinds of investors differ from, say, the early crypto VCs who are maybe placing riskier bets? And how does that affect how they'll work with Stablecoin X long term?
That's a really important distinction to make. We can only speculate, of course, based on the size and nature of the deal, but it's highly likely these investors are a sophisticated mix. You're probably looking at prominent VCs who really understand market infrastructure, not just protocols. Large institutional funds, maybe pension funds, endowments, and potentially even established traditional finance players who want a serious entry into Web3, not just a punt. Yeah, unlike some early-stage VCs taking flyers on experiments, these folks are likely after more mature, infrastructure-focused plays. They probably want clearer regulatory paths, sustainable long-term returns. Their reasons might go beyond just hoping the price goes up. It could be about strategic influence, maybe hedging against traditional market risks, or even setting up future integrations between their own traditional products and the digital world. This isn't just throwing money around, it's a strategic statement about where they see finance going. It validates the whole idea of stablecoin-focused treasuries. And that's the key insight here, I think. This massive investment, it doesn't just benefit Stablecoin X alone. It's fundamentally a huge vote of confidence in the entire category of these stablecoin treasuries and their role in the broader DeFi landscape. It suggests the market, especially big capital, sees the need for robust, well-managed treasuries to backstop stable digital assets. And those assets are foundational for DeFi's future. That legitimization is just paramount.
That really sets the stage well, because like you said, beyond the immediate price reaction, this capital injection seems to point towards the future of Web3. Let's talk about the power of that $530 million. Fresh capital. It gives Stablecoin X considerable leverage, right? What does that leverage actually mean in practice? How might they use it? And what could the ripple effects be in this stablecoin world?
Excellent question. Because it's way more than just having a bigger bank account. This kind of leverage gives Stablecoin X a dramatically bigger capacity to scale up and innovate their treasury-backed stablecoin products. We're not just talking about keeping the lights on for existing stuff. This money lets them significantly expand operations, invest in crucial innovation, maybe even develop totally new stablecoin products or services. Imagine being able to buy and manage a more diverse, more resilient portfolio of traditional assets. That means even stronger backing for their stablecoins. They could explore different types of collateral, maybe beyond just treasuries. They could integrate with faster, cheaper Layer 2 solutions. Or even design new stablecoins addressing issues like capital efficiency or moving between different blockchains. How might they deploy it? Well, it's a safe bet. A big chunk will go into acquiring really robust, highly liquid traditional assets. The go-to example, like we see with others, is short-term U.S. treasuries. They're safe, liquid, stable, exactly what you need for credible backing. By beefing up their reserves with trusted assets like these, they seriously enhance the perceived safety and stability of the stablecoins they support. And that makes those stablecoins way more attractive to everyone, from big institutions to individual users who just want reliability. So this capital isn't just for Stablecoin X, it creates this positive ripple. It raises the bar for stability and trust across the whole ecosystem. Now, the challenge, of course, is managing such a huge treasury effectively, staying compliant legally everywhere, being transparent, all while operating in this super fast-moving digital world.
Right. And Ethena, with its USD, that decentralized synthetic dollar, it stands to benefit directly from all this increased stability and trust in the background. Can you walk us through that connection and maybe clarify how USD is different, how it's innovative compared to, say, a USDC?
Absolutely. Athena's approach is pretty innovative. It's a decentralized synthetic dollar protocol. So unlike traditional stablecoins like USDT or USDC, which basically try to hold a real dollar or something very close to it, in a bank for every digital dollar they issue, Athena's USDe does things differently. It aims for that stable peg using a pretty sophisticated mix. They use staked Ethereum as collateral, but also employ what's called called delta hedging strategies in the derivatives market. Now, delta hedging, simply put, is using complex financial tools futures options to constantly adjust their exposure. The goal is to offset potential price swings in their crypto collateral, like the staked ETH, to keep USDe pegged to the dollar, even when crypto markets get volatile. So while USDC is backed by actual dollars or equivalents, USD is synthetically pegged. It uses crypto-native tools and financial engineering to achieve stability. It's a different beast. And Ethena benefits directly from things like Stablecoin X's investment because it boosts the whole stablecoin treasury ecosystem. Think about it. A stronger, more trusted infrastructure for stablecoins, generally one that's validated by big institutional money and backed by reliable treasury management that directly supports innovative protocols like Ethena. When the whole stablecoin market gets more robust, more secure, more accepted by institutions, confidence naturally rises in all the credible players. That includes those offering new ideas like decentralized synthetic dollars. And this is huge for Ethena. Protocols like theirs need market confidence, deep liquidity, solid backing. This investment strengthens that foundation significantly. It signals to the market that the underlying mechanics for stable digital assets, even synthetic ones, are maturing and getting serious traction. That could lead to USDe being used more in dApps, getting more users.
So yeah, this isn't just a crypto story. It really feels like it highlights that bigger narrative we keep seeing. DeFi and traditional finance are converging faster and faster. We're talking real-world asset tokenization, RWAs, and just the continued massive growth of stablecoins.
You've absolutely nailed a critical point there. This development is right at the crossroads of two massive trends reshaping finance, RWA tokenization and the stablecoin economy. Let's unpack RWA tokenization a bit more. It's this groundbreaking idea of taking real-world things, government bonds, office buildings, commodities, even art or IP, and putting them on the blockchain as digital tokens. Why is this such a big deal? Why is it attracting so much capital now? Because it fundamentally changes these often illiquid, sometimes opaque traditional assets. It turns them into highly liquid, transparent, programmable digital things. Things you can trade 204/7, fractionally owned so smaller investors can get in, and seamlessly plug in to DeFi protocols. This could unlock literally trillions in value currently stuck in old, inefficient systems. And this is exactly where stablecoins become absolutely essential. They're the grease in the wheels. They act as the bridge currency, the main way to buy and sell, the crucial on-ramp and off-ramp for these tokenized real-world assets. I mean, if you want to trade a token representing a U.S. Treasury bond or a piece of digital real estate or slice of a private equity fund on-chain, you absolutely need a stable digital currency for that transaction. You can't be dealing with wild crypto swings at the same time. Stablecoins provide that stability, that anchor. So if we connect this to the bigger picture, the long-term implications, they're immense. Maybe hard to even fully grasp yet. We could see totally new financial products that blend the best of both worlds. The security, compliance, yield of traditional assets, combined with the efficiency, transparency, programmability, global reach of blockchain. This shift means dramatically more efficient global finance, much lower transaction costs because you cut out middlemen, and potentially a fundamental reshaping of how assets are owned, traded, settled. Imagine traditional assets, once locked up geographically, becoming globally accessible, super liquid on-chain for a whole new generation. This institutional interest isn't just a test drive. They're laying the groundwork for a future where a huge chunk of global finance might run on blockchains. It could democratize access to wealth generation in ways we haven't seen before. Of course, the regulations need to catch up, which is both a challenge and an opportunity.
Okay, so connecting back to the listener, what does this all mean for someone like you trying to navigate these fast-moving waters as an investor or trader? Let's break down the real impact on different types of market folks, starting with people already holding ENA.
Right. For current ENA holders, that immediate 12% price jump, it's a very clear signal of market validation. No ambiguity there. It suggests the broader market, especially the institutional side, sees this big investment as a major positive for Ethena's whole ecosystem. It indicates newfound confidence, maybe long-term potential. This kind of institutional backing can bring a real wave of positive feeling, hinting at more stability down the road, better liquidity, a stronger base for growth that's maybe less speculative. It suggests Athena's perceived as having passed some kind of credibility test. But this is crucial. Hilitos holders need to see both sides of this validation. While it's definitely positive, it also inherently ramps up volatility risks, especially for an asset that's still relatively new, relatively early stage. You know how it is in crypto. Fast run-ups, driven by big news, can often be followed by corrections. Early investors take profits, new dynamics kick in. For ENA, being newer and innovative, this means, yes, potential for big gains if adoption continues, but also a need to be more watchful of market swings, maybe more speculative trading around future news. So if you hold ENA, maybe it's a time to reassess your risk tolerance, your long-term view. If you're thinking about investing now, it highlights momentum, but also screams, do your homework, understand the mechanics, the risks. This isn't really a set it and forget it investment. It needs active monitoring.
Okay, makes sense. What about the pros? The traders looking for those market movements, the arbitrage plays, the directional bets. How does something like this change their game?
For professional traders, this is fascinating. Potentially very lucrative. The increased liquidity and exposure that just naturally comes with a $500 million institutional stamp of approval, that could lead to bigger price swings. And bigger swings mean significantly more opportunities, especially for derivatives trading. Think about it. Higher liquidity means it's easier to buy and sell large amounts without moving the price too much against you. That's huge for big traders, the whales, who need to move serious capital efficiently without getting killed by slippage. And more exposure. That means more eyes on ENA. It draws in a wider crowd, algorithmic desks, high-frequency traders potentially boosting trading volume across the board, spot, and derivatives. And more volume, more institutional interest often means more volatility, which is exactly what sophisticated traders love. They're good at leveraging these conditions. They might use futures betting on future price, options buying the right to trade later, perpetual contracts those futures without an expiry date. These tools are perfect for playing volatility. Making directional bets, complex hedging, finding tiny price differences between exchanges, arbitrage. This situation could be really fertile ground for them. The order books probably get deeper too, offering more ways to execute complex strategies.
Sounds like a playground for the pros. But what about retail investors? The average person interested in DeFi, maybe not trading futures, but trying to understand the space. How does this big institutional nod shift things for them?
Absolutely. This is a really profound shift in the narrative for the average individual investor, too. It signals that stablecoin-focused DeFi, it's not just some obscure niche corner of crypto anymore, understood only by early adopters and tech wizards. It's now demonstrably attracting serious capital from serious, established players. It's getting, you could say, legitimate mainstream attention within finance. For many people, this clearly indicates the space is maturing. It's moving beyond just speculative experiments. We're seeing more robust, institutionally backed ventures emerge, ventures with the capital and the infrastructure to build for the long haul. And that's a crucial takeaway if you're following DeFi's growth. It's kind of an aha moment. It shows DeFi's legitimacy, its reach, extending way beyond the early days. It's really an invitation to understand this evolving landscape better, because the infrastructure being built now, validated by this kind of money, is likely going to be the foundation for a lot of future finance, digital and traditional. It feels like the financial world's center of gravity is shifting a bit. These new efficient rails are attracting serious long-term capital, and that generally signals maybe a bit less systemic risk compared to purely retail-driven hype cycles. So for retail investors, it means opportunities are still there, but the market's getting more professional. You need a better grasp of fundamentals, risk management, not just chasing the latest buzz. It's a call to level up your own understanding.
Okay, so keeping that in mind, what does this mean for you navigating these waters in the bigger picture of Web3? Let's zoom out again, look at the wider ecosystem implications, because this affects more than just Ethena, right? First up, we have to touch on the stablecoin wars. We know Tether, USDT, and Circle, USDC, are the current giants. But projects like Ethena are pushing for decentralized options. Can you map out that landscape for us? Where does Ethena fit in this fight?
Yeah, the stablecoin battlefield. It's definitely dominated by those two titans. Tether's USDT and Circle's USDC. Both are centralized, mostly fiat-backed, meaning they try to hold $1 or something very close like a treasury bill for every digital token issued. Their advantages are clear: massive adoption everywhere, deep liquidity for huge trades, widely accepted for payments, trading, remittances. They're kind of the default. But there are potential downsides, right? Centralized control means single points of failure. One company holds a lot of power, and they face constant, increasing regulatory scrutiny about their reserves, how transparent they are, how they operate. That can create uncertainty. Now, into this picture comes Ethena's USD. It's a decentralized synthetic dollar, and that represents a fundamentally different philosophy. The core difference is huge. Decentralization aims to remove that reliance on one company, one authority. It distributes control, reduces censorship risk, a key idea in Web3. Practically, Athena's backing mechanism is totally different from holding dollars. It uses staked ETH as collateral, plus those complex delta hedging strategies with derivatives to maintain the peg. It's algorithmic and collateralized, trying to mimic dollar stability without holding actual dollars. The potential benefits: more censorship resistance, no single entity can easily freeze your funds. More transparency, maybe, through its on-chain workings. Less counterparty risk from a central custodian facing outside pressure. But it has its own trade-offs. Maybe capital efficiency questions, reliance on oracles for price data, the inherent risks of smart contracts and derivatives failing. It's a different model, designed for resilience and autonomy inside the Web3 ecosystem, but with its own unique risks.
So with this kind of institutional backing showing up, even indirectly, do you think Ethena could genuinely challenge the dominance of USDT and USDC? Or is it more likely to just carve out its own, maybe significant niche? And this raises a key question for you, the listener. Do you think Ethena could challenge DAI, USDT, and USDC as the stablecoin of choice for a big chunk of the market?
That is the multi-million, or maybe the $500 million question right now. Look, directly challenging the sheer size, the years-long head start, the deep integration of USDT and USDC across everything, that's an incredibly tough fight. Athena, with this growing institutional nod, it's certainly positioned to do more than just carve out a tiny niche. It could capture a really significant market segment. Its appeal lies with those seeking a truly decentralized, transparent, censorship-resistant option. Combine that with the institutional confidence we're discussing. It could become a major player for specific DeFi use cases, especially where those core Web3 values, decentralization, permissionlessness, are absolutely critical. Think about DeFi protocols that prioritize being built purely on-chain, resistant to outside control. USDD could become their go-to stablecoin. It might not replace USDT or USDC everywhere, especially for getting money back into traditional banks, but it could definitely become the stablecoin of choice for a certain fast-growing part of the market, potentially even rivaling DAI, the other big decentralized option, by offering a different risk-reward setup and backing. The market's big enough for multiple winners, and Athena's making a strong play.
And speaking of institutional nods, this huge investment feels like a massive boost for institutional DeFi legitimacy overall. What does that actually look like when traditional money starts seriously validating this space?
Precisely. These treasury investments, like the $530 million for Stablecoin X, play this vital, almost irreplaceable role in legitimizing decentralized models in the eyes of traditional finance. It's not just about the money itself, it's profoundly about credibility, trust, signaling. When large, established entities with their deep pockets, their rigorous risk management, their intense due diligence commit this kind of capital, it sends a huge signal to the rest of the financial world. It implies the underlying tech, the financial models, the risk frameworks in these DeFi protocols are seen as robust enough, mature enough, secure enough for serious long-term investment. And that's critical because traditional institutions are naturally cautious. They need clarity on compliance, on operational integrity. This validation from institutional players is a crucial stepping stone. It acts like a catalyst. It paves the way for broader institutional adoption, not just of stablecoins, but maybe a whole range of DeFi protocols. It creates a domino effect. If one big player is comfortable, others start looking seriously. That brings more capital, attracts top talent, fuels more innovation. It really mirrors the early days when Bitcoin or Ethereum started getting institutional interest. Those moments are pivotal. They shift perception from weird internet money to legitimate investable assets and infrastructure. It signals the homework's been done, the risks weighed, a path to return seen. Makes it easier for the next institution to follow.
Okay, finally on the broad implications, let's talk macro trend. Stablecoins as key liquidity tools in a world that frankly feels increasingly unstable. This seems like a really critical function they're performing now.
This raises a really important, very relevant question, doesn't it? What is the evolving role of stablecoins when the world feels like it's grappling with more economic and political instability? The analysis definitely suggests stablecoins, including synthetic dollars, are becoming key liquidity instruments within Web3. They offer this critical function in turbulent times, and maybe even starting to impact traditional finance flows. They act as this crucial haven from the wild volatility you see in other cryptos, right? But they let you stay within the digital asset world. Imagine you want less exposure to Bitcoin swings, but you don't want to cash out completely to fiat, which might have its own inflation problems or capital controls. Stablecoins are that digital safe harbor, a predictable store of value on-chain. And during times of global uncertainty, high inflation, geopolitical tensions, big downturns in traditional markets, demand for stable digital assets can surge. They offer a way to store value separate from local currency issues, and they enable incredibly efficient, cheap, cross-border payments, often bypassing slow, expensive traditional banking systems, which might have heavy controls or even sanctions. This makes them incredibly powerful for global trade, remittances, especially in developing nations. Looking ahead, you can speculate. How might countries or major corporations start viewing stablecoins? If traditional financial systems face serious stress or major currencies become unstable, could these digital assets become a kind of de facto digital reserve for certain things, a neutral, efficient, global medium for trade, investment? The way Web3 relies on them for liquidity certainly points that way. The demand for digital stability, especially when traditional stability is shaky, is a huge driver for this whole sector. It suggests stablecoins are moving beyond just being crypto trading tools. They might become foundational elements of a future global financial system.
Yeah, these aren't just isolated incidents, are they? They feel like pieces fitting into a much bigger puzzle. And we have some great supporting stories, real-world examples that really drive these points home. They illustrate this convergence beautifully. Let's start with MakerDAO and their RWA allocation. That feels like a perfect example of a DeFi protocol using traditional assets, proving the model works.
Indeed. MakerDAO, the group behind the DAI stablecoin, they made huge waves by strategically moving billions of dollars from their treasury into U.S. treasuries to back DAI. This was profound because it showed a major established DeFi player actively embracing TradFi instruments. Why? To make DAI more stable, more resilient, and to generate yield for the protocol. They wanted to diversify their collateral, be more capital efficient, and earn sustainable low-risk income. And this strategy, it directly mirrors what Stablecoin-X is doing, or aiming for, using traditional super liquid, low-risk assets to provide strong, tangible backing for a decentralized stablecoin. It's pragmatic, it acknowledges the deep liquidity, the trust, the regulatory clarity that exists in traditional markets. But it wasn't simple. They had huge debates within the MakerDAO community, the trade-offs between pure decentralization versus pragmatic yield generation. Eventually, they voted for this hybrid approach. So it's not just theory, it's a proven path for DeFi protocols looking for stability, yield, and wider institutional trust. MakerDAO's move shows this treasury-backed idea isn't brand new, it's a sophisticated evolution. DeFi strategically securing its value, building solid bridges to the TradFi world. It proves the model is not just viable, but actually desirable.
And then there's Ondo Finance, another player actively building that bridge, tokenizing treasuries, making them accessible in totally new ways.
Right. Ondo Finance is another excellent concrete example of this RWA tokenization trend gaining speed. It shows how that TradFi DeFi bridge is being built, block by block. Ondo focuses specifically on tokenizing U.S. treasuries. They take these assets, which are normally hard for average folks or even smaller institutions to access directly, and put them on-chain as digital tokens, available globally to a blockchain-native audience. How? They set up legal structures, hold the actual treasuries in regulated custody, and then issue corresponding tokens on different blockchains. So they're creating these on-chain versions of real-world assets, turning a piece of a government bond into a digital token you can hold, trade, use in DeFi, maybe even as collateral. This attracts institutional flows because it solves problems. It gives traditional investors blockchain efficiency and reach without crypto volatility. And it gives crypto natives exposure to TradFi yields and a more stable investment. For you, the listener, it shows exactly how this bridge is being built. Innovative projects finding inefficiencies, building solutions benefiting both sides, democratizing access to assets that used to be exclusive. Now, it also introduces its own risks, smart contract bugs, needing reliable price feeds, oracles, ensuring the legal claims on the underlying assets are solid. But it's convergence in action with all its complexities.
But, like you said, it's not all smooth sailing. We have to remember the cautionary tales. The collapse of Terra USDe, that's a stark, unforgettable lesson about stablecoin fragility.
Oh, absolutely. The UST collapse back in May 2022. It's a pivotal, incredibly painful reminder. It showed why robust, transparent, liquid backing is utterly non-negotiable for any stablecoin, no matter how clever its design seems. UST wasn't backed by dollars or bonds. It relied on this complex algorithm tied to its sister token, LONOA. The idea was arbitrageurs would magically keep the peg stable, but when the market went nuts, the peg broke. That triggered a horrific death spiral. Both UST and LONOA just plummeted, wiping out tens of billions of dollars in, days. It was a massive wake-up call for the whole industry, regulators, users, everyone. It brutally highlighted the need for real, external, easily verifiable collateral. Without that, algorithmic stablecoins are just inherently vulnerable to extreme stress-coordinated attacks. So this story provides crucial context for why investments like Stablecoin-X's are so important. It's not just about growth. It's part of an industry-wide move towards demanding greater stability, transparency, confidence through reliable, verifiable backing. It's a direct lesson learned from one of crypto's biggest, most devastating failures. Stability stability can't just be wished into existence by algorithms. It needs something tangible underneath.
Right. And on the flip side, even Tether, the biggest stablecoin, which has faced plenty of scrutiny itself over the years, even they've been evolving their reserves towards more traditional backing. That says a lot about market demand, doesn't it?
It really does. Tether, USDT, which historically got a lot of criticism for, let's say, lack of clarity around its reserves holding things like commercial paper. They've clearly shifted strategy recently. They've moved towards a much more transparent model, heavily backed by U.S. Treasury bills, especially short-term ones. They publish attestations about this regularly now. This shows a clear industry trend. Even the biggest player, who maybe didn't feel they had to be transparent before, is responding. Responding to market demand for clarity, to regulatory pressure, and definitely to the lessons from things like USDe. By increasing transparency and loading up on reliable, liquid assets like T-bills, Tether is trying to solidify trust, reduce perceived systemic risk. This evolution just further validates how critical, robust, verifiable treasury backing is for all stablecoins, centralized or decentralized. It's what the market increasingly demands for long-term trust, stability, and regulatory acceptance. It's like a race now to prove you're stable and trustworthy.
And if anyone needed more proof that traditional finance is taking this incredibly seriously, just look at the Wall Street giants like BlackRock getting involved. Their participation feels like a potential game changer.
This might be one of the most powerful signals, absolutely undeniable. When giants like BlackRock, the world's biggest asset manager, we're talking over $10 trillion, start showing serious active interest in on-chain treasuries and asset tokenization, it shifts the conversation from if this happens to when and how fast. Okay. BlackRock getting involved means the idea of tokenized assets, using blockchain for treasury management. It's not just some crypto niche fantasy anymore. It's not just for small, agile startups. It's now a serious, strategic, long-term initiative for the absolute biggest players on the planet. I mean, what does it signify when the world's largest asset manager starts exploring this, putting resources in, even launching their own tokenized funds, like their BUIDL fund, tokenizing T-bills? It points to a future where a huge, maybe enormous chunk of global assets might end up tokenized and managed on-chain. BlackRock brings immense credibility, institutional infrastructure, a clear path for others to follow. Their due diligence is legendary. So their entry signals a level of perceived safety and opportunity that was hard to imagine just a few years ago. This isn't just crypto going mainstream anymore. This is mainstream finance embracing crypto's underlying tech to revolutionize its own operations, efficiency, access, ultimately profits. It's the highest form of endorsement, really, and it just accelerates the timeline for mass adoption of RWAs on-chain.
Okay, so we've covered the immediate splash, the strategic importance, the real-world examples showing this convergence. Let's try and tie it all together now with some key numbers, some metrics, and look ahead at what might be next. We mentioned ENA's price chart, that 12% jump, clear market reaction, but let's look broader. What does the growth in the overall stablecoin market cap tell us about the fundamental shift happening here?
Yeah, the overall stablecoin market cap growth, it tells this really compelling story of increasing adoption, deeper integration into the global financial system. When you compare the growth path of centralized giants like USDT and USDC versus decentralized ones like DAI or Athena's USDe, you see that while the big guys still dominate, the decentralized options are steadily growing. They're carving out significant market share, clearly driven by demand for things like censorship resistance, transparency. The total market cap for all stablecoins has just exploded in recent years, from relatively small beginnings to hundreds of billions of dollars. That exponential growth shows how important they've become. They're like this fundamental everywhere layer of the digital economy, the critical bridge between volatile crypto and stable fiat, and the specific growth in decentralized stablecoins. That highlights a real persistent demand for alternatives offering different benefits, transparency, autonomy, less reliance on single companies. It shows they're useful not just for trading, but as core financial building blocks.
And zooming back in on Ethena specifically, beyond just its price, what about those on-chain adoption numbers? Things like wallet growth, total value logged, TVL on the protocol, the amount of USD actually circulating. What do those reveal about real-world use?
Those on-chain metrics are absolutely crucial. They give you a real ground-level view of Athena's actual usage, acceptance, integration within DeFi. It moves beyond just price speculation, wallet growth. Shows how many unique people are actively using the protocol, holding USD, signals organic adoption, wider reach. If that's growing steadily, it suggests real interest, not just temporary hype. Total value locked. TVL, that's the total amount of money currently locked in Athena's smart contracts. It's a direct measure of the ecosystem size, how much confidence people have in its security, its overall usefulness. Growing TVL means increasing trust, deeper integration with other apps, better capital efficiency, and USD circulation tracks how much of their synthetic dollar is actually being used out there, reflects its liquidity, market acceptance, its role in transactions. So looking at these together helps you understand, is Ethena just a token people are betting on, or is it genuinely building a useful foundational piece of DeFi infrastructure, providing a stable medium of exchange or store of value for real users and protocols? Healthy growth across these metrics, that signals strong fundamentals.
We should probably also touch on stablecoin dominance, their slice of the total crypto market cap pie. What does that metric tell us about how their role is evolving?
Yeah, stablecoin dominance as a percentage of the total crypto market cap.
Yeah.
It's a really important indicator, sometimes overlooked. It shows their growing importance, their foundational role. Sure, during big bull runs, stablecoin dominance might dip a bit as money chases hotter, more volatile assets like Bitcoin or altcoins. But their steady growth overall and their significant, consistent presence, often around 10-15% of the total market cap, illustrates they're the primary liquidity layer. They're fundamental. They aren't just temporary parking spots for cash or trading pairs anymore. They're the essential medium through which a huge amount of the crypto world transacts, saves, hedges risk, moves value. So that metric really underscores their core function. They underpin almost everything else in crypto: trading, lending, new protocols. Growing dominance signals the market's increasing reliance on a stable digital base layer.
And then there's that projection we mentioned, institutional RWA inflows, especially tokenized treasuries, possibly hitting $10 trillion plus by 2030. That number is just staggering. Mind-boggling.
It absolutely is. And when you put all these numbers together, they paint this very clear, frankly revolutionary picture of where finance might be heading. Not only is the stablecoin market maturing, getting more diverse, more resilient, but that convergence with real-world assets. It's projected to be a multi-trillion-dollar industry. This isn't some niche market anymore. It's an economic force expected to fundamentally reshape global financial markets in the next decade. That $10 trillion plus projection for tokenized treasuries by 2030, it's not just wishful thinking from crypto fans. It's coming from serious analyses by big institutions, BlackRock, Bernstein, others. It reflects this belief that institutions will increasingly use blockchain for massive gains in efficiency, transparency, accessibility, and managing traditional assets. It points to a huge paradigm shift in how value is stored, exchanged, leveraged across finance, potentially democratizing access to institutional-grade investments, unlocking huge liquidity for assets that were previously hard to trade. What's driving it? Demand for better yields, global access, the pure efficiency of blockchain tech fractional ownership, 24/7 trading. This isn't just about moving money faster. It's about fundamentally redesigning the plumbing of global finance. And all this raises several really important questions, things for you, the listener, to maybe chew on after we wrap up here. First, thinking about the competitive fight. Do you believe Ethena, with this kind of institutional tailwind and its innovative synthetic dollar, could realistically challenge the established giants DAI, USDT, USDC for a broad user base? Or is it more likely to carve out its own, perhaps specialized but significant niche in DeFi appealing to certain users? Second, long-term versus short-term. Will this institutional capital truly provide a sustainable boost for ENA's value, driven by real adoption and utility? Or will it mainly just fuel short-term speculation and volatility, like we've seen happen with so many other crypto assets after big news drops, making it more of a trader's playground than a foundational hold? Then, thinking about stablecoins themselves. Is this treasury-backed DeFi model, blending TradFi reliability with decentralized tech, truly the future? Does it offer a robust, genuinely decentralized alternative? Or are we maybe just recreating some old centralized risks, like depending heavily on the stability of U.S. treasuries just in a new digital package, possibly with new failure points? And finally, a really personal one about trust, which is everything in finance. When it really comes down to it, would you personally trust a decentralized synthetic dollar like USD with its complex algorithms and hedging? Would you trust it over the more familiar, even if centralized options like USDT or USDC? And maybe more importantly, what specific things would influence your trust the most? Is it transparency? How decentralized it really is? The exact backing mechanisms, audits, perceived regulatory safety. These are the questions that will ultimately shape how widely these things are adopted.
Wow, those are some incredibly thought-provoking questions. They really bring home the complexity, the significance, and the personal side of everything we've discussed today. So just to quickly recap our journey here in this deep dive, we started with that immediate tangible impact Stablecoin X's $500 million investment hitting Ethena, seeing that 12% price jump as a clear market signal. Then we dug into the deeper strategic importance of these treasury-backed stablecoins, understanding how this capital fuels growth, boosts stability, and really speeds up that convergence of traditional finance and Web3.
These aren't just random news blips, they feel pivotal, shaping the future of digital finance, setting precedents, drawing serious institutional eyes to this rapidly growing multi-trillion-dollar space. As we wrap up, we really hope you'll continue exploring this fascinating intersection, real-world assets meeting decentralized finance. Maybe dive deeper into some of the projects we mentioned, like MakerDO or Ondo. Keep an eye on the stablecoin market cap. Look at the on-chain numbers for Ethena and its competitors. Check out some of those reports on RWA tokenization from the big financial players.
The more you explore, the better you'll grasp the immense potential and the subtle challenges shaping our financial future. It helps you participate smarter. And we'll leave you with this final provocative thought to mull over. As these lines between traditional and decentralized finance keep blurring, as more assets get tokenized and become accessible on-chain, will the stablecoin backed by real-world assets, whether directly fiat-backed or synthetically engineered, eventually become the universal currency of the digital age? A truly global, efficient, borderless way to transact in a connected world? Or will the whole concept of a stable digital asset, living in an inherently volatile digital world, remain one of crypto's biggest ongoing experiments? Forever trying to solve the complex puzzle of trust, true decentralization, and navigating the ever-shifting landscape of markets and regulations. It's a huge question. Definitely something worth pondering long after this deep dive ends. Thanks so much for joining us.